So welcome, ladies and gentlemen, to today's webinar from 21 Shares invited Felix Fernandez from Open Metric Solutions. And the subject today is actually super interesting because I've never seen a webinar like this, which is called Combining Regulated Crypto Products with Traditional Assets: How to Improve Risk-Adjusted Returns for Fixed Income Portfolios. My name is Sina Meyer, and I'm with 21 Shares responsible for the Swiss markets, and I'm very excited today to invite you to our webinars. Welcome also to Felix Fernandez to today's webinar, and today Felix today will be our slide master. Maybe let's go to the next page. So 21 Shares, just to introduce you quickly who we are a Swiss company registered in Zug, and we are a fintech company with our offices in Zurich at Brandschenkestrasse. Next slide, please. A couple of numbers to introduce you what is going on. So we are the first, like you could see in my banner, the first worldwide ETP issuer for crypto assets. We have over 1 billion assets under management currently. We have 12 ETPs in different currencies, and we are existing for about 2.5 years. Next slide, please. The people in our company, we are about 35 people at the moment, with the two co-founders, Henny Rashwan and Ophelia Schneider, who wanted to create something for institutional clients to have a great solution for your portfolio. Next slide, please. This is an overview just for all the ETPs, what we are doing. We have 7 single trackers, we have 4 indexes, and we have one, the only one, actually, the first one, Bitcoin Short ETP. Next one, please. So first, before we start this cool session, some figures which might interest you a lot, because I was personally super surprised about these big figures. So the overall market cap of the whole crypto industry is currently 1.8 trillion. I think that's pretty amazing, and it's getting bigger and bigger. 60% of it is Bitcoin, so it's about 1 trillion is Bitcoin. And there are over 300 different trading venues, such as crypto exchanges, derivatives, OTC desks, and of course also our ETPs. 200 billion a day is the trading volume of the crypto market, and I find this super exciting. I had no idea that this market is so big. So it's super liquid, and 100 million are already using cryptos, which is actually only 2.5% of the internet population. And at the right side hand, you see a kind of a balance from all the people using internet, and then compared to the crypto asset industry, which is still very small. So there's a lot of upside potential. But let's go to the next slide, where you can see also the asset allocation of the individuals worth over 30 million. And as you can see that there is only 1% in crypto, so the potential is huge. 27% of properties as an investment, equities. And today we will, of course, also talk about the bond fixed income and how you can combine this with cryptos. So next slide, please. This is a slide I really admire because it shows you really well. It's a chart which I like a lot, which was created from our research team. So it shows you Bitcoin goes through cycles, sometimes speculative, so too high, and then it falls for a while. And every time Bitcoin hits a new all-time high, we go into a kind of bull phase for almost a year. In 2013, as you can see on the slide, Bitcoin crossed only $80 for the first time. Then the price increased 38 times over 1,000, and 2017 from about 1,100, 1,200, then to 17 times up to just under 20,000. So now we cycled there where we are at the moment, which is crossed actually today about around 58,000 this morning. And we now think that this is the time where will even more extreme, because since Corona, not only retail, but also institutions are looking around for alternatives. It's the first ones to have already come in, the retail. And as soon as we see more coming in, I think it will be even go further up. So it's a very, very strong impact on the market. And so Corona has not a negative impact on Bitcoin, but quite at the opposite for a very positive one. So now I'm delighted to hand over to Felix Fernandez, who will show you more about how to improve risk-adjusted returns for a fixed income portfolio. Welcome, Felix.
Yeah, thank you, Zina, for the kind introduction and for the opportunity to present today together with you another practical application on how to integrate cryptos into a traditional portfolio. We'll start with a short introduction about us. We are a spin-off from ETH Zurich, founded in 2016 and focused on risk management topics. And one first note, and this is why we think that this webinar, this kind of webinar can create value, is that it answers the question, how should I, and to which extent should I include or incorporate cryptocurrencies into my portfolio? Should I do it at all? And often when you look at the press and you look at let's say, communication about moves in the crypto space, people are sometimes fascinated about growth, on the other side, frustrated about, let's say, adverse movements. But you have to understand that cryptocurrencies simply move in a different space, if you want. So they have a higher volatility, but they have also extremely high returns. And when you look at it properly, they are much closer to bonds than you would expect. So let's, with no further ado, let's dive into it. So one of our core philosophies, if you want, is the topic of measuring something. We have here one of the most known physicists who developed the Kelvin temperature scale, William Thomson, Lord Kelvin. And his claim was that you basically have to measure something before you can improve it. And this is also our claim. So we focus on measuring financial markets, and I will come to it in a minute what we exactly mean by that. Now, getting to the content of this presentation. Now, bonds are always an essential component, or in most of the cases, an essential component of investor portfolios. Looking at pension funds, for example, why? Because bonds per se deliver a relatively high Sharpe ratio. But nevertheless, the problem that we're having is that with decreasing or even negative interest rates, the returns or the performance of a bond portfolio is very low, or moves even into negative ranges. And the problem with that is that you're not getting then, let's say, appropriate compensation for the risks that you are taking. So what happens? Well, some investors, we know some family offices who have decided to do that. They basically move completely out of bonds. Other investors have to keep them, and let's say then have to look at how to accept these risks, especially when they want to have some returns. They typically have to accept also higher risks. So for example, bonds with low ratings from different countries, or if you're talking about corporate bonds with, let's say, from different companies. Yes, there are active strategies. You can do bond arbitrage, for example, where you go along a corporate bond with a much higher return, and then you go with an lower rating, and you go then short maybe another bond with a better rating, so that you can somehow eliminate the market risk, and you can create somehow market neutral returns. But these strategies are complex. They require a lot of market expertise and typically limited in capacity. And also you often incur other systemic risks, which are probably not so transparent. What we want to present today is a very simple approach where we just add a tiny fraction of Bitcoin in this example to a bond portfolio. And what we can see then is that the performance improves significantly, which then generates an additional buffer for the effects that we fear when we're just holding bond portfolios alone, which are interest rate hikes, which would then automatically create an impact on a bond, negative impact on a bond portfolio. Briefly about us, so we are a spin-off from ETH. We work now for many years for institutional clients mainly. We have a large repository of algorithms, and in the meantime also developed a good, let's say, client base. A little bit of history. So the technology we're building upon has been developed across more than 13 years of research at ETH. We have some advanced technologies. I'm just touching a bit today, so I'm not going too deep into it. But what you can see is that we have basically a very solid foundation. So all of our methodologies are peer-reviewed, are documented, are transparent, and we are building on top of the shoulders of many, let's say, developers and key researchers in the academic field. Our core technologies are based on the dissertation of my co-founder, Dr. Tobias Setz. So the important point is that all our methodologies, as I said initially, are fully transparent. And this is also the reason why we have in the meantime several pension funds as clients, because one of the requirements is, for example, having a fully transparent and explainable methodology. So why the results are as they are, in contrast to other approaches, which I don't want to go into deeper today, but I'm just touching it, like machine learning or AI-based technologies, where very often it's hard to explain why the AI delivered a certain result. In this case, the methodology is a relatively complex, but fully transparent statistical methodology. Now, going a little bit further into the core, and the reason why I added this is that I don't want to give you just a black box and say, well, okay, just use risk management and that's it. So I want to explain where we are coming from in a more, let's say, generic way. And one of our core beliefs is that you cannot forecast financial markets, at least not in the timeframes that are relevant for most of the investors. And the reason for that is basically a mathematical foundation which has been laid 50 years ago or even longer by Russian mathematician Lyapunov, who defined the so-called Lyapunov time. And Lyapunov time is like an invisible barrier, if you want, for every physical system. Over this barrier, it is impossible to make any meaningful prediction. And the reason for that, and this is somehow explained in this block diagram, if you go from left to right, every system, physical system in this world consists typically of two components. So one is random and the other is deterministic. So there are no, in theory, there exists. In reality, there is nothing like a purely random system. So pure randomness is basically also not possible to achieve, or at least very difficult. The same is for deterministic systems. So even if you have a mechanical watch, for example, which is very deterministic, you have some effects, and this is the chaos which comes in, which, if you want, creates small deviations, which then create in the long run, so if you go for long prediction periods, the so-called butterfly effect. So small changes in the input create massive variations in the output. Practical examples. Something which you're probably not thinking about immediately is planetary orbits. Planetary orbits follow a very mechanistic approach. Yeah? So they can be predicted for millions of years. But even there is a systemic limit, this Lyapunov time, which tells you that over this time limit, you have chaotic effects and random effects, which make a 100% prediction impossible. Now, it may seem a little bit abstract, but the idea is to make clear that there are systems which long prediction periods and systems which much shorter prediction periods. Probably the best researched forecast landscape, if you want, is the weather. There are tons of proven and well-designed weather forecasting models. But here also the Lyapunov time says that regardless of how powerful your computing engine is, how, let's say, good your algorithm is, you cannot forecast the weather across a certain number of days. It can be 5, it can be 7, it can be maybe even 10, but there is certainly a limit where weather predictions fail. And I mean, all of us are aware of that. And for financial markets, this field is not so well researched, but from what we know so far is that predictions for longer, let's say, time periods, so everything which goes over seconds typically is basically impossible to determine. And the reason for that is that the random component is very strong. So you have a very strong random element in financial markets, which makes basically any prediction meaningless. Yeah, so a random system cannot be predicted by definition. So what do we do instead? So instead, we focus on a precise measuring system. And what we do for that is to better understand how the mechanics or dynamics of a financial market work. Now, without going into all the technical details, what we do is we calculate the information that we find in financial markets time series, and we derive from that a term or a measurement which is called stability. And stability is basically a combination of 3 inputs. So one is trend, which all of you know probably. The second is volatility or risk, which all of you also know. But the third dimension is then information about a so-called structural break. And a structural break tells you when the dynamics of such a market change. And a good visualization is the stability matrix. The stability is nothing else than basically a standardized visual and numeric representation of what I said initially. So taking these 3 inputs and calculating information about the current status of the matrix. Now, what you do is, if you look here from left to right, you're coming from different regimes, and the visual representation is a little bit like a traffic light. So red or 0 in terms of value means that you should not have exposure in this market, or you should hedge 100%. And if you're going higher, then you can have a much higher exposure. If you're around 0.5, this is somehow a neutral market development. And once you are in the green field, this means then you can hold a much larger exposure so that the market is in a stable phase. And if you do this properly and use this properly, and properly means that you have your rebalancing and risk management process adjusted to that, you can on the relevant frequency, depends a little bit on your solution, on your portfolio. It can be weekly, can be monthly, it can be quarterly. What you do is you measure the current status of the market, and then you act on that. And that is basically the philosophy. And in order to do that, you need a timely fashion. And you may ask, well, okay, what is new here? So what is new is that we are using a methodology, which is a Bayesian methodology, which has the advantage that it's much faster and show very low lag when you are working with time series. For those who are interested, there is tons of material. You can go to our website or reach out to us. We are doing also in-depth sessions for people who want to understand the mechanics in detail. So here, just touching the basis for what we are doing now. Now, coming to the core, or to the beef of the presentation today. What we want to learn is what happens if I add Bitcoin to a bond portfolio. Now, what we show is 2 variations. One is the so-called passive approach. So you're just adding Bitcoin as is in a fixed proportion. And there is a dynamic approach. The dynamic approach uses a risk management overlay to control the exposure. And I will show you immediately what what the difference is between these two approaches. And of course, we can combine the bond portfolio with either a passive approach, so having a small fixed proportion. You can do this today, it's very simple, or you go an extra mile and implement then a dynamic approach where you control the exposure of Bitcoin dynamically. So the approach here in detail is basically what we have to do first is we have to compare two types of Bitcoin exposure. So either a passive exposure, understand what this means in terms of return, volatility, risk-adjusted return, and drawdowns. These are the most relevant measures typically for an investment. The same for a dynamic. So when we have a dynamic exposure, so we are not exposed always 100%. Instead, we have a methodology which tells us to how much exposure we should hold. In this case, it's of course based on market stability, which I alluded to it before, which is basically our methodology that we prefer. And then looking at this, at the real world use case, is then to combine a US bonds portfolio. We took here an US bonds portfolio for a very simple reason. As Bitcoin is also traded in US dollars, it's simple, let's say, and also important to avoid any currency effect. So this is if you want pure Bitcoin exposure with a US bonds portfolio. For those who want to know more of the details, it's here in the legend. So we're using across different maturities, treasury bonds and corporate bonds. So we combine a US bond portfolio with a fixed exposure and again with a dynamic exposure. Now, looking at part one. The passive and dynamic Bitcoin comparison. And I know it's a little bit a involved slide, but it's important to understand and to really digest it because it tells you a lot about the mechanics behind it. I start with the blue line. And just the blue line is simply Bitcoin in US dollar. So the top chart shows the curve. The middle chart shows the drawdowns. And the bottom chart is for the dynamic exposure. I'm coming to it in a minute. So when you look at the blue line, you see also the first line in this, let's say, numerical results here. So you see annualized return from 174% almost, or 173.79, a volatility of over 80, which results in a very high Sharpe ratio of 2. And this is what makes Bitcoin so interesting, is what many people, from my perspective, not fully understand. You have to look at Bitcoin from a risk-adjusted return perspective. So look at the Sharpe ratio. Please do not look at returns only. It's important to look at returns and risk in parallel. And the maximum drawdowns. As you can see, the maximum drawdowns have been historically quite significant, something you would probably fear when you have an equity portfolio. And equity portfolios are not as good as you may think. I mean, the MSCI World lost more than 50% in the 2008 crisis. So, and not even closely generating similar annualized returns. So from a risk return perspective, Bitcoin is quite good. What irritates it is that it's basically in the landscape, it's relatively far away from your traditional assets. Now look at the black line. The black line in the middle is a traditional passive hedge, or we call it here a blend. So what it makes is that what you do is on a, in this case, weekly basis. You can do this on a monthly basis. The results are very similar. What you do is that you keep your risk buckets controlled. So what you do is you are keeping 50% in Bitcoin and 50% in cash. This is the black line. What happens with the black line and why do we use that? Well, first, what happens? It halves the returns, but it also halves the risks, almost, but not fully. You see that the maximum drawdowns, the maximum drawdowns are still higher than what they should be. And the reason for that is that moves can be faster than your rebalancing frequency. But generally speaking, such a passive hedge is not very good. it's quite an expensive form, if you want, of protection. It protects you only roughly 50%, but it also consumes 50% of the performance. Can we do better than that? And the answer is yes. You can do this better, significantly better, with a dynamic hedge. So our aim, and this is what we do also for pension funds in the equity space and in other asset classes like commodities and so forth, is that you apply a dynamic risk management where your exposure is not static. So it's not 100% always. Instead, it moves, like in this case, between 100 and 0%. And this is where this waterfall diagram at the bottom comes in. So where you see the dark blue shaded part, it's 100% exposure. And you see like a waterfall then around 2014, 15, moving down to 0 and then slowly getting up again, then again standing at 100%, and again 2018 going back down to 0 and so forth. So this is what this stability measurement, the stability measurement tells us what do we have to hold in exposure. Normally, every risk management procedure costs money. So many people think, well, risk management is a free lunch. It's not. So as said before, the passive hedge costs money. So it consumes performance and you have to do something. You have to do a continuous rebalancing. But you know that rebalancing it can be expensive if you do it very frequently. Now, what the green line does, and you see especially in the drawdown phases, it protects much better against severe drawdowns. And you may say, well, okay, the drawdowns are still significant. Yes, they are. But in the context, again, we're in the context of cryptos, if everything here is roughly in line. So if you would, for example, just think about 1/10 of exposure, and you divide the annual return by 10, the volatility by 10, and the maximum drawdown by 10, you would still have the same Sharpe ratio, but then a maximum drawdown of 6.5%. So just to give you an idea that you have to think differently when you look at Bitcoin investment than when you look at traditional investments. So this is just to show you that with a risk management model, we can create some value, and we see how this reflects. And this is probably then the next one is the most important slide, because it shows you what happens when you add a relatively small proportion of Bitcoin to this bond portfolio I mentioned before. So you have a well-diversified bond portfolio. And you see here the black line here is exactly this bond portfolio. Now you may think, well, yes, bonds are fine. So you have an annual return here across this time period of almost 3%, a volatility of 3%, so your Sharpe ratio, which is close to 1, which is good. But you have also drawdowns, which are mainly triggered by interest rate moves or speculation about interest rate moves, which are significant. So we have drawdowns of 5 to 6%, which is bad, especially when you have to wait for quite a while. So after such a drawdown, you have to wait maybe 1 or 2 or 3 years before you're just back to 0, if you want, or back to normal. Now, if you just add 4% of Bitcoin to such a bond portfolio, you are getting the blue line. So 4% fix is a very simple recipe, if you want. What happens? Now look at the return. You have an annualized return which jumps from close to 3% to over 8%. A volatility which is just a little bit increased from 3.5, let's say, or 3.2 to 4.8%. So you're getting a Sharpe ratio which is closer to 1.8, which is very good. And the maximum drawdowns are still in a very similar range. So it's roughly not even 1 percentage point higher in maximum drawdowns, but your annualized return is roughly 2.5 times higher, which is great. So it's a very simple and recommendable approach to do that. Now, what happens if it goes wrong? Now, imagine that your Bitcoin exposure loses 50% of the value. Well, yes, you would, of course, have a drawdown of 2% in your portfolio. But in contrast, also comparing this with the, if you want, intrinsic drawdowns of your bond portfolio, this is relatively small. So there is a significant added value. Now, if you do that on a dynamic basis, so we remember maybe the green curve from the slide before, yeah, so basically using this dynamic approach, the dynamic approach does not seem very different in the first round from a risk perspective. It's quite close, but you are getting even higher returns. So in this case, the returns go up to over 11% annualized return. And this is due to the fact that we can simply protect a little bit better the effects. And what we do here is that we have a bandwidth. The bandwidth of this exposure moves between 2 and 6%. So on average, our exposure is also 4. But in phases where the market, if you want, compensates you for taking risks, so when the market is stable, we take slightly higher risk, so we go up to 6%, but we also go never below 2% in this case. Why we don't do that? It's a little bit a matter of let's say, how you build a portfolio, and you can do this, of course, in many other variations. From our experience, it's better to have a bandwidth which leaves a certain minimum exposure, which helps you to capture upside moves much better. And from the downside perspective, they are acceptable. So this is, if you want, the core element of it. So just to summarize, if you look at Bitcoin, if you take a dynamic Bitcoin instead of a static Bitcoin, you can maintain similar returns, but you have a slightly higher Sharpe ratio. But this is not the main point. The main point is that you can reduce the maximum drawdowns. So this is the advantage of combining Bitcoin with a risk management concept. But more important, what happens to your bond portfolio? If you just add a small Bitcoin exposure, it improves your Sharpe ratio and significantly. So it improves your returns significantly without changing too much on your risk parameters. And of course, the dynamic exposure, as I alluded before, provides even higher returns. So this is, in a summary, is quite an interesting result. And just also thinking about it from a risk perspective, again, it's important to understand that you have to treat Bitcoin properly and in the right proportion to any traditional asset. And this is the reason why we just add a small portion to the bond portfolio. Now, just two, let's say, additional information. First, it's important to see this on a landscape. I mean, when I talk about Sharpe ratio, it's something a little bit abstract. But what the Sharpe ratio basically does, it puts a return and volatility here as risk in perspective. So it is important to have a high, or it's better to have a higher Sharpe ratio than a lower Sharpe ratio. Why? Because if you have the same returns with a higher volatility, it's always preferable to have this with a lower volatility. So your uncertainty about the outcome is lower when you have a low volatility. So this is typically desired. And you see here that bonds are in a Sharpe ratio field of 1. By adding Bitcoin, you see what happens. Just with adding this fixed proportion, you are shooting up your portfolio to a Sharpe ratio close to 2. And with a dynamic approach, we take a little bit more risk, but we're also having higher returns, but we maintain the same Sharpe ratio approximately. So this is the visualization of this outcome of adding Bitcoin to a portfolio. Last but not least, many people ask, well, okay, this is one dimension, but what is another dimension? And you have always to look in a portfolio context to correlation. And the important message here is when you compare in this yellow square, you see basically the correlation between bonds and Bitcoin. And it's two pieces of information. One is a numerical representation of this correlation, which is in the upper right corner, is a 0.05. So it's a very, very low correlation. So everything around 0 or even below 0.5 has a low tendency. So this is almost 0. So you can probably say that there is no meaningful correlation between the two. And you see this in the visual representation. You see basically this field, yeah, of no clear let's say correlation points between the two, which is a very good visual interpretation. The others are here in this context not so relevant. They show you basically the correlation between the other two approaches and so forth. But important is to understand that you're getting a significant diversification effect when you combine these two asset classes. So this is all from my side. I would now hand over to Zina. Again, if you have any questions going more into detail or would like to understand how we work in this regard, I'm happy to reach out, and yeah, Zina will guide you now to the next part of or the last part of the presentation.
That was super interesting. Thank you so much, Felix, for this very exciting presentation, because I have personally never thought that in a bond portfolio putting some Bitcoins inside. I thought, like, when Felix proposed me this webinar, I thought, like, now he's getting wild. But well, we have the solution for you at 21 Shares, because if you think that, yes, that might be a solution for us as well, for our portfolio, we might have the solution for you. Next slide, please, Felix. So we have, like Felix mentioned several times already, a very regulated, safe, and really good solution, which are for institutional clients as well, of course. So we have this ETP where you find all the data at the right-hand side. You can also find this on our webpage. We are actually fully collateralized. Everything what we buy, if we buy the Bitcoins, we really physically buy them. We stock them professionally with a custody, and we hold it for you, so nothing to do with that. Super easy, physically backed and segregated from our accounts. So nothing if 21 Shares will go bankruptcy, what we don't think, because we have more than 1 billion asset under management, but you never know. Your funds will be saved. Then, what I said, everything is regulated. We have liquidity. We have liquidity makers, actually professional liquidity makers who are Jane Street or flow traders. So the liquidity is not an issue for your portfolio with our solution. Then the costs are pretty low as well for the crypto industry. For the Bitcoin is 149 per annum. And we have also very low spreads, which is important, of course, as well. So if you do a big ticket or even a smaller one, it's between 10 and 30 basis points, which is for the Bitcoin or for the crypto industry quite amazing. And we have listings, of course, at SIX, Deutsche Börse, Wiener Börse, BX Swiss, etc., etc. You go and check what we can offer you. Next slide, please. We put together for you a nutshell for the ETP. So ETPs, what is it? It's actually like an ETF structure in terms of regulations. Just the only difference is that in terms of ETF, ETP, it's not under Sondervermögen, which is kind of this special money which you put away from your accounts, but we still do this. It's segregated from our accounts, so it's very, very similar to an ETF. We have transparent NAV every day, which is super important for you. And of course, you can only trade it at the opening hours from the exchanges. So it's not that you can trade at the weekends. It's kind of similar like a stock, I would say. Then very, very limited issuer risk, like what I said, for segregated from our accounts. Crypto is fully collateralized, listed on regulated segments of stock exchanges, independent market makers. And what's very important for you, you can use your existing bank or broker. No need to transfer your money out from your portfolios. Keep the money where it is at your bank or broker, and you can do this very easily. Then next slide, please. This is super important now. If you have any questions, you can ask them now. And Felix, myself, I have a question for you, because I did not understand, how do you do the rebalancing?
Okay. Well, in principle, it's very simple. When we are talking about, let's take the let's say most simple approach, you have a fixed proportion on your portfolio. It is important that you maintain this proportion. Here in this modeling, we have shown this on a weekly basis, but as I said initially, you can do this on a monthly or even quarterly basis. So important is that on your desired frequency. Asset managers typically work on a monthly basis, investment or pension funds, so that you look that your portfolio value does not exceed this defined range of roughly 4%. Of course, it's a matter of decision. You can put a little bit less, you can put a little bit more, but generally speaking, it's important to keep this in line. And then you just do the typical rebalancing process that you buy and sell your positions to keep the desired portfolio weights in place. Why this is important? It's important from a risk-adjusted returns perspective. So if you just, for example, start with 4% Bitcoin, and let's say Bitcoin doubles in value within 1 month, Bitcoin has then, if the other assets do not move, then 8% in your portfolio. And you will be happy because you will say, wow, I have doubled my money. That's great. But there is also a downside that you have also doubled your risk in your portfolio. So it's important that this rebalancing is done by buying and selling the positions so that you maintain and keep this exposure that you're designed to have. And with your products, it's relatively straightforward because you can just buy and sell them via the ISIN number with any bank or broker.
Thank you. Interesting. Very good. There might be another question. Where can we see or follow the ETP performance? This is also important on a daily basis. We have these kind of questions. So you can see it on the webpage of 21 Shares. We have also very cool newsletter where you're updated on a weekly basis what's going on in the crypto industry combined with finance, which might help you a lot to follow up as well. You can check also on Bloomberg. Just make sure our ETPs are in US dollars, euros, Swiss francs and pounds, that you compare actually sometimes the apples with the apples and the peers with the peers, because sometimes in terms of different currencies, it might give the impression that you have a different performance, but actually it's not. Our ETPs follow exactly the underlying, so in this case, the Bitcoin price. We do nothing else to take the ETP and make sure that it's the same like the Bitcoin or the underlying price. And I would say, like, if there are no other questions, Felix, I don't know if you have another question, I would say, like, thank you very much. Let me just check if there is another question again. There is another question again. You mentioned that a very tiny proportion can be invested in Bitcoin. What is the range of proportion is defined by the word tiny?
Well, anything around, let's say, 2 to 6%. If you go significantly over that threshold, depends a little bit on your portfolio. We have been doing some simulations and analysis on that. If you cross, let's say, that roughly 10% of your portfolio share, then I would say the risk is too close, or you're getting too much risk into a portfolio, or put it the other way around, your portfolio is getting dominated too strongly by the volatility of Bitcoin. So it's important to keep it within this range. So I would say anything around this range of, let's say, 2 to 6%, it's quite a healthy range. And I would call it tiny in terms of what is the maximum acceptable drawdown that you are willing to accept if you have a strong negative move in Bitcoin. And this depends on your portfolio. So if you have, for example, a bond portfolio, as mentioned before, which has a maximum drawdown of 5%, well, then if you lose 1 or 2% on your Bitcoin proportion, I would regard this as acceptable. There is always a little bit of room for interpretation, but from our experience, probably this is let's say the best range I could give. Anything between 2 and 6 is typically can be defined as a tiny proportion that does not impact your portfolio on a highly negative basis. You have to think about, especially about the negative moves, not only about the positive moves.
Thank you, Felix. So I think that's it, because if you have no further questions from your side, maybe like next slide at the last. And I wanted to thank you for your attention and for following it. And it was very nice, Felix, to have you with us today in this super interesting presentation. If you have further questions in the future, please feel free to contact Felix or my side. On the next slide, you will see my contact details. And you, like I said, if you want to be in this crypto, you want to be updated from a daily basis or from a weekly basis, I have to say, follow us on www.21shares.com. Go on a website. You can also register for the newsletter, which I mentioned, which is very, very well done, I think, and is also a big plus for you to have kind of assistance what's going on in the market. Thank you very much to everybody. Have a very nice day and see you soon again. Thank you.
Thank you also from my side, and thank you, Zina, for the very professional organization and the opportunity to present with you together around the very, let's say, challenging and interesting topics in this crypto landscape. Thank you very much.
Thank you very much. Bye-bye.
Bye-bye.